Okay, let's come to this question now. From the following data, identify whether the options are exercised or not. This is just a pure revision question kind of thing. Keep the basics in mind. When the market price is high, the call option gets exercised. When the market price is less, put option gets exercised. Now, future spot price, which means market price on expiry, that's what we mean. Market price on expiry. Or whether option gets exercised or not. Think only from market price point of view. Don't think from strike price point of view. Look at this. Market price is 100, more than strike price. When market price more, call option gets exercised. 2000, market price is less, call option will not be exercised. When the market price is more, call option exercised. When the market price is less, put option is exercised. 9,000 less than 850, 900 less than 850, that is the 900 is more, put option not exercised. 5,000, 5,100 lesser, put option likes it, exercised. 237, 234, market price is more, call option exercised. 415, 410, market price is more. Please tell me this. 415, market price more than strike price. What will happen to put option? Market price is more, 415. When the market price is more, put option not exercised. It will lapse. When the market price is more, call option exercised. Not put option. When the market price is less, put option exercised. Okay. 27, 24, market price is more, call option exercised. 80, 74, market price is more, call option exercised again. 900, 910, market price is less. When the market price is less, call option not exercised. 567, 517, market price is more, put option, market price is more, not exercised. 148, 153, market price is less. When the market price is less, put option exercised. 58, 49, market price is more, call option exercised. 849, 842, market price is more, call option exercised. You also please give a try. Let me know if you have any doubts. Okay, hope it's fine. Let's go further. Okay, let's do this problem now. Calculate the profits and losses from the following transactions. These are 4 separate transactions. X writes a call option to purchase the share at an exercise price of 60 for a premium of 12 per share. The share price rises to 62 by the time option expires. Mr. Y buys put option at exercise price of 80 for a premium of 8.5 per share. The share price falls to 60 by the time option expires. Mr. Z writes a put option at an exercise price of 80 for a premium of 11. The price of the share rises to 96 by the time option expires. Mr. XY writes put option with the exercise price of 70 for a premium of 8 rupees. The price falls to 48 by the time option expires. Okay, so these are 4 different instruments, 4 different situations. Normal what column we used to prepare? Let's follow same thing. Market price, intrinsic value, premium, payoff. But in this problem, strike price is different in every case. So let's also have one column for strike price. Normally we don't have one column for strike price because same in every column. But as a thing here, every strike price different in 4 cases. Let's have one column for strike price also. Okay, so first situation, everything situated separately. Let's have one column for market price on expiry. Then let's have the strike price as one column. Then intrinsic value. Intrinsic value depends on call or put. For a call option, it is market price minus strike price. Of course, can't go below 0. Put option, strike price minus market price. Of course, can't go below 0. Premium. Then payoff. Payoff for the holder, it will be, no, we will have one more payoff, correct. Payoff for the holder, it will be intrinsic value minus premium. For the writer, opposite. Premium minus intrinsic value. These are 4 different questions. So you can prepare 4 separate tables also. For saving time, I'm preparing one. But ideally, you should prepare 4 separate tables because each table has different situations, different products. The first one, then we go for second, then we go for third part of the question, then we go for fourth part of the question. Okay. Mr. X writes a call option at an exercise price of 60. So strike price, exercise price, both are same. Premium of 12. Premium of 12. Exercise price 60. Okay. Share price rises to 62. Share price rises to 62. Yeah, for example purpose, I would say if they ask you a question like this, prepare separate tables, 4 separate tables with the same heading. You can repeat so that it is separate situations. You can present in one table also, but you should know that these are 4 different questions. Preferably 4 tables, but to save time, you can write one also. For exam purpose, it's fine, but you should be clear. These are 4 different products. Now, intrinsic value. Market price minus strike price, 62 minus 60. Will the call option be exercised? Again, let me have one more column maybe. Type of option. Because in each case, this call or put is different. Let me have one more call for type of option. And this is call option. Call option. Now in call option, market price more than strike price. Is call option exercised? Call option, market price more than strike price. Always think from holder point of view. Don't think from writer point of view. Writer don't make decision. It may be beneficial to him. It may not be beneficial to him. He is not going to make decision. Decision is made by the holder. So when market price is more, option exercised. Intrinsic value 62 minus 60, it becomes 2. Now, can you please tell me what is the payoff is going to be? How much is the payoff in this case? Is it plus 10 or minus 10? In this case, minus 10. Mr. X writes a call option. Writes a call option. For a writer, I have given the formula also, heading, so much table also we discussed, everything is wasted, graph also we have written. So premium minus intrinsic value, heading also have written. For a writer, premium minus intrinsic value, 12 minus 2. Premium minus intrinsic value. For writer, it is minus 2 only. Yes, intrinsic value we write plus 2, but while calculating, we take minus 2. So we subtract it. So intrinsic value is applied at negative only. Absolutely. Okay. Then second one, Mr. Y buys a put option. Put option. Mr. Y buys a put option at exercise price of 80. Okay. At an strike price, exercise price of 80. For a premium of 8.5. For a premium of 8.5. The share price falls to 60. The share price falls to 60. Now, market price less than strike price. Market price less than strike price. So, is the option exercised? Again, think only from the holder point of view. Put option is exercised when the market price is less. And the intrinsic value is going to be strike price minus market price. So, strike price is 80 minus market price is 60. You get 20. Now, what is going to be the payoff? Mr. Y buys a put option. Buys a put option means for a holder. For your reference, you can write. The previous one was for a writer. You can say C minus. And here for a holder. So for a holder, it is intrinsic value minus premium. 20 minus 8.5. 11.5. This is for put option holder. Or you can write here also position. It was call option writer and this is put option holder, P plus. Okay, next. Mr. Z writes a put option. Mr. Z writes a put. It's a put option and writes. So P minus. Writes a put option. Exercise price of 80. Strike price of 80. Premium of 11. Premium of 11. And the price of the share rises to 96. So market price on expiry 96. You might be a writer, but the decision is taken by the holder. So think from the holder point of view. Market price greater than strike price. So 96 minus 80. How much will be intrinsic value? 96 minus 80. How much will be intrinsic value? Put option not exercised by the holder because the market price is greater. When market price is greater, option not exercised. Option not exercised means intrinsic value becomes 0. The option will lapse. And this is for the writer. So what is going to be payoff? Premium minus intrinsic value, that is 11 minus 0, entire 11 rupee is the return for the put option writer. Next, Mr. XY writes a put option. Again, Mr. XY writes a put option at an exercise price of 70. At an exercise price of 70, strike price. Premium of 8 rupees. Premium of 8 rupees. Share price falls to 48. It falls to 48. Now, 48 less than 70, put option, market price less than strike price, option exercised, intrinsic value for a put option, strike price minus market price, which is 70 minus 48, which is 22. And what's going to be payoff? Intrinsic value minus premium, premium minus intrinsic value for a writer. For a writer, it is premium minus intrinsic value. So it is 8 minus 22. You get minus 14. Put option right. Let's go to the solution once more. See if you have any doubts. What is the doubts? P minus, I have written. No, P minus I have written. I have written P minus. Okay, hope it is fine. Okay, let's go further. Okay, so come to this problem. Mr. John. Mr. John established the following spread on the TTK stock. This kind of question is repeatedly asked in exams. Purchased one 3-month put option with a premium of 15 at an exercise price of 900. Purchased one 3-month call option at a premium of 90, exercise price of 1100. TTK Limited stock is currently selling at 1000. Calculate gain or loss if the price of the stock of TTK Limited remains at 1000 after 3 months, falls to 700 after 3 months, raises to 1200 after 3 months. Assume the size of the option is 200 shares of TTK Limited. So assume the size of the option 200 shares of TTK Limited. This means the lot size that we multiplied by later. Anyway, it's purchased only one contract. And what they're asking, calculate the gain or loss, meaning payoff, net profit. If the price of the stock remains, falls, raises. They are giving you 3 market prices on expiry. Let's have the same formats. One column, we will have market price on expiry. But remember, you have taken one put option also, one call option also. So many number of columns will come. One set of columns for call option payoff separately. One set of column for put option column separately. Then total. So market price and expiry, there are 3 situations possible. 1, 2, 3. And I'm going to have a tabular format like this. One set of option will do for call option list. Then we'll do for put option, same list. Then I'll do overall. So one I'll do for call, then I'll do for put, because he has done both. No point in preparing separate tables because the same person is taking position in both. So do column 2 in the table only, both the positions and total net overall. Call, put, overall. In call option, what we are going to do, strike price, we don't want to have a column. You can avoid it, or if you want, you can write it. But I don't usually write because it will be same under all the cases. So call option at, what is the strike price? At an exercise price of 900. Put option at exercise price of 1100. Okay. So what are the columns? We will have market price and expiry, that is common to both. We will have intrinsic value. Then I will have premium. Then payoff. Here also intrinsic value. Premium. If you're writing premium shortcut, either write PR or write full premium. Don't write prem and all. Does not look nice. If somebody looks at your answer sheet suddenly, they should not think differently. Some name and all should not be there. Either write PR or write premium. Then payoff. Overall payoff. Okay. So intrinsic market price on expiry remains at 1000, one situation. Falls to 700, second situation. Rises to 1200, third situation. Now intrinsic value. For call option, it is market price minus strike price. For a put option, it is strike price minus market price. Okay. So what is market price? In this case, 1000. Market price 1000. Strike price 900. So 1000 minus 900. Market price is more. Call option holder. To be specific, you can write C plus here. And here also he purchased. He purchased means he bought it. Buyer of the option. Buyer of the option is called as holder. So C plus, and here you can say P plus. Holder. Both the cases. Okay. So intrinsic value. Market price 1000. Strike price 900. 1000 minus 900. 100. Premium of 15. Payoff becomes 85. Put option at a exercise price of 1100 and market price 1000. So is the put option going to be exercised? Market price 1000. Strike price 1100. Market price is less. Now will the option be exercised? Oh, sorry. I think I did the mistake. I'm sorry. My mistake. First one is put option. No. First one is put option. I made the mistake. Sorry, numbers are reverse. Let me just take it out. First one I took it as call option. First one is put option they have given. So we should be careful in these matters. So first one is put option. So first I should come to the second column. I'm sorry. In a flow I taken call first. That's my mistake. First one is put option. Put option. Market price is 900 and strike price is 900. Market price is 1000. Market price is more. 1000. Market price is more. Strike price is less. When the market price is more, put option not exercised. So this becomes 0. It becomes 0. Premium, you paid 15 rupees. Payoff for the holder, intrinsic value minus 15, that is intrinsic value minus premium, 0 minus 15 minus 15. So this heading I have written wrongly. Heading also please change it. Heading also was my mistake, I think. Call option at 1100. Put option at 900. Call option at 1100, put option at 900. Okay. Now coming to the call option. Will call option be exercised? Market price is 1000. Strike price is 1100. Will call option be exercised? Call option. Market price is 1000. Strike price is 1100. Market price is less. Not exercised. So this also 0. Premium is 15 rupees. Payoff minus 15. No, not premium 15. Premium premium 90. Oh, 90 rupees. Okay, 90 rupees. 90 rupees premium minus 90. Now, one of the shortcut people follow, I said don't follow it. They say it like if call option not exercised, put option exercised. No, don't think that. Look at the strike price. We had got call at 1100, put at 900. So if it was below 900, we will exercise put option. Above 1100, call option exercised. But this 1000 became between call and put. So put option, it is more. For call option, it is less. So in between those two, both are not exercised. This is one strategy followed. If it is between the two prices, you don't make profit. If it falls or it goes above, you make profit. So these are the different strategies that people follows. Anyway, so when the market price is 700, I mean overall payoff minus 90, minus 15, so minus 105. Minus 90, minus 15. Total payoff minus 105. You can multiply it by lot size. Lot size is 200. So total payoff multiplied by 200 if you want. Minus 105 into 200. I think minus 21,000. Minus 21,000. So you would lose entire amount, 21,000 loss, gone. If the market price comes to 700, okay, call option, market price is less, call option not exercised. Premium 90. Minus 90 is going to be loss. What about put option? Market price 700, market price down, put option will help you. Put option is exercised. And how much is going to be intrinsic value? Strike price 900 minus market price 700, intrinsic value 200. Premium 15 rupees. So you get 185. Intrinsic value minus premium. For the holder, intrinsic value minus premium. 200 minus 15, 185. Total 185 and minus 90. 95 profit. And you can multiply it by 200 to express in total number of total amount number of units. 19,000 profit. Last went to 1,200. Now market price is high. Call option exercised. And intrinsic value market price minus strike price. 1,200 minus 1,100. Which is 100 rupees. Premium we paid 90 rupees. So 10 rupees is going to be your profits. And intrinsic value, what about put option? Market price is 1,200, the strike price is 900, market price is more. When market price is more, you don't come to put option, not exercised, it will lapse. 15 rupee premium you paid is gone, entire minus 15 rupees your loss. 10 rupee profit here, minus 15 here, overall loss 5 rupees and multiplied by 200, you get minus 1,000. So you can see how the profit can be different. The loss range is too much. Loss can be minus 20,000 or profit can be 19,000. So many ranges. Okay, hope you got this one. Let's go next. Okay, let's do this problem now. The next one. Fresh Bakery's share price has suddenly started moving both upward and downward on a rumor that company is going to have a collaboration agreement. Don't think how it can be both upward move downward. It means it's volatile. It's moving fast like this. Both upward movement. That's what they meant. On a rumor that company is going to have a collaboration agreement with a multinational company in the bakery business. If the rumor turns out to be true, stock price will go up. But if the rumor turns out to be false, the market price, the share will crash. So either on higher extreme or down extreme, too volatile stock. To protect this, an investor has purchased the following call and put option. 1 month's call with a strike price of 52 for 2 rupee premium per share. 3-month put option strike price of 50 for 1 rupee premium per share. Are you understanding his strategy? His expectation is either price going up or price going down. I want to make profit in both situations. In futures, you know what we used to do? Market price goes up, take long position. Market price comes down, take short position. That's all, over. No other things. But in options, they're not like that. In different views, you can make profit. Your view, market price goes up, become call option holder. Market price comes down, become put option holder. I know market price will come down, but not below this point. Then you can become call option writer. I know market price will go up, but not beyond this point. Become put option writer. So many possibilities are there. Here, what you're trying to do in this case, I want to make profit when the market price goes up, or I want to make profit when the market price comes down. If it is not moving, that's okay. I make loss. See, even in the volatile market, you can make profits. In options trading, so many alternatives possible. That's why 90% of the market trading happens in options, because so many contracts, so many alternatives. So in this problem, if the market price goes up, you want to make profit. So what he did, he bought a call option. If market price comes down, he want to make profit. He wrote a put. He has purchased a put option. So market price coming down, put option gives him profit. Market price goes up, call option gives him profit. Market price does not change. In both cases, he lose. I mean, you can't have a profit everywhere. You have to have opinions. You have to have views, and based on the views, we have to take position. If your views are correct, you can get profit. But the problem in futures was your views are limited, either going up or coming down, but not both, or many other situations. Options will give you any view. Going up, you take position. Coming down, you can take position. Does not change, you can take position. For any of your views, there exists an strategy available in the options. You make profit if your view comes true. If your view does not come true, of course, you have to make loss. That is universal. Okay, so let's have the same format for this. Assume the lot size is 50 share. Determine the following. Investor position. If the collaboration agreement push and the share price 53 in 3 months, the investor ending position if the collaboration agreement fails and the price crashes to 46 in 3 months. So under 2 situations will follow. Again, same format. So we will have market price on expiry. Then we will have one call option position, and you are becoming call option holder, and you are becoming put option, or you are purchasing put option also. So put option position, then we will do overall, same format. Okay, so in call option, what is the strike price? Strike price at 52, put option strike price 50. This is 52, this is 50. And same 3 columns, intrinsic value, premium, payoff, intrinsic value, premium, payoff. Then overall. whatever per unit, then total into number of units if lot size available per unit. This is per unit, then total. Market price on expiry, they said either it will become 53 or 46. 53 or 46. 52. Okay, if the market price 53, call option 52, whether it will be exercised. Market price 53, strike price 52, market price more. When the market price is more, call option gets exercised. So intrinsic value 53 minus 52, it becomes 1 rupee. Premium paid already 2 rupee. So you have a loss of 1 rupee. Intrinsic value minus premium for a holder. For put option, market price 53, strike price 50, not exercise, 0. Premium you paid 1 rupee, so 1 rupee entirely gone. So 1 rupee gone here, 1 rupee gone here. So minus 2 rupees, lot size 50. So minus 2 into 50, you lose 100. Even though it's crashing, I mean, even though it's going up, not going up enough to cover your cost. So even though it goes to 53, you make loss. It should have gone to 55, 56 maybe. Anyway, 46. If it price crash to 46, that is market price 46, call option strike price 52, market price is less. When the market price is less, call option not exercised, lapse, 0. And premium pay 2 rupees, that is gone, entire 2 rupees loss. Put option, market price is less, put option exercised, and strike price minus market price 50 minus 46, 4 rupees. And premium is 1 rupee, so you get 3 rupees. So 3 rupees profit, 2 rupee loss, overall 1 rupee profit. Market lot is 50 units, so you get 50 rupees profit. 50 rupees profit. Okay, see if you have any doubts in this one. Okay, hope it is done. Let's go further. Okay, so good morning, my dear future chartered accountants. Hope everybody is doing great. Can you please confirm first that my voice is audible and the PPT is visible? Yes? Okay, thank you. Thank you very much. So we are doing options. Let's straight away get into the topic. What we are going to do next is all about option valuation. You know, there are basically two types, call option, put option, and we have called as option premium. So what is a transaction? What is the cash flow that takes place today and that is option premium. And what is the cash flow that takes place on expiry date? You can say strike price, you can say intrinsic value if the option is exercised. Hope you know the basics of it. So what we are going to understand now is all about what is supposed to be that option premium. What is the connection between the option premium and intrinsic value? What are the other factors that are going to be considered? Is there a connection between put option premium and call option premium? Things like that we are going to uh, understand. So what are the things which are covered here in options valuation parts? We have things like a put call parity, PCPT, basically which connects value of call, value of put. Then we have something called as option valuation, or let's say what are the factors affecting the value of option, like time to expiry will have an impact, interest rate will have an impact, then things like that. What are the factors that is going to have an impact on option valuation? And then we have, for that actually we have something called as Greek, option Greek, that is when one of the factors change, how the option premium changes. Like one of the factor is market price. If market price change, how option premium change. That is called as option Greeks. We have things like delta, gamma, theta and all. But to understand, to calculate those things, we need one more important thing, that is valuation models. We have two valuation models basically. One is called as binomial model, and one is called as Black-Scholes model. Black-Scholes model. And in put call parity theorem also, if theorem does not hold good, we are going to learn how to understand or how to construct arbitrage. And in binomial model, we have things like delta, delta hedging, option hedging, uh, risk neutral probability, multiple binomial model. I mean, I'm not telling these to scare you, so that you understand what is our next set of action is going to be. We already learned basics of options. We have learned option strategies. We have to learn now about option premium, how it is calculated and how it is different from theoretical calculation, what are the opportunities exist. So these are the things we have to understand. First, let's go to put call parity theorem. Put call parity theorem. Parity, you don't know in English what is the meaning of parity? Parity means something equal, something same. Comparing the two, are they equal or not? In futures we have done actual future market, fair value of futures. How did we compute fair value of future? By compute from spot market. That is spot market adjusted for time value of money. We got the fair value of futures. I compare the actual future and see whether they are equal or not. Kind of parity. If they're equal, there is no arbitrage opportunity. The fair value is correct. If they are not equal, arbitrage opportunity exists to make use of imperfect market price. That is what is put call parity theorem is all about. So put call parity theorem, let me give the formula. Put call parity theorem. The formula goes like this. Let me give the formula directly. VC, that is value of call, plus present value of strike price is equal to value of put plus current market price. VC is value of call. VP is value of put. SP, you understand? Strike price. CMP means current market price. Current market price of underlying asset. Current market price of underlying asset. Current market price of UA, underlying asset. Maybe gold, commodity, shares, index, anything. Value of call, nothing but call option premium. Value of put, nothing but put option premium. Put option premium. Basically, this is the connection between four variables. This theorem tells you, parity theorem, this should be equal. If it is equal, parity theorem exists. If the equation does not tally, the two sides we have, left hand side, right hand side, does not equal, it's not matching, then parity theorem does not exist, arbitrage opportunity exists, right? So if LHS equal to RHS, hope you understand, left hand side, right hand side equal to RHS, that means parity exists, or parity exists, theorem exists. Parity exists. If LHS not equal to RHS, then we say parity does not exist. Parity does not exist. Parity does not exist means, what do you mean by that? That implies arbitrage opportunity exists. Arbitrage opportunity exist. Parity does not exist, which means arbitrage opportunity exists when, if the left hand side is not equal to right hand side. This is the actually summary. What is the derivation behind this? What is the interpretation of this theorem? And how do we construct arbitrage strategy? We are going to discuss all of those things. So hope you have written till here. Okay, done. Okay, let's first understand a little bit about this interpretation of formula. Not really required for examination, just for your referential point. What is this formula basically represents? This basically tells you whether the variables are connected. In the sense, if this theorem does not hold good, what does it imply? We'll come to all of those things. Now, as far as the interpretation is concerned, there are two things which I can explain theoretically and one practically. Let me explain theoretically first. Just for reference purpose, you don't have to write down all these things. You don't have to write down all these things, just for you to make you understand. And practical interpretation also I'll tell you. Now imagine there are two people. One person who wants to purchase the shares today and another person who wants to purchase the shares on expiry. Two people are there. One person purchasing the shares today, other person purchasing the shares after expiry. Whether those two people positions are same. There are different ways of interpretation. This is one of them. Okay, so don't try to write it. Just try to listen, sufficient. Let's say there is person 1 who purchased the shares today 40 rupees and he purchased 12-month put option at a strike price of 60 rupees. Understanding the position? He purchased the shares today and he purchased a 12-month put option today at a strike price of 60 rupees. After 12 months, let's say market price is 65. Now, where do you think he is going to sell his shares? Do you think, is he going to sell the shares in the market, or do you think he is going to sell the share in the options? If he sell in the market, he will get 65 rupees. Market price is trading at 65 for this share. But in the option, you have right to sell at 60 rupees. Obviously, you are going to sell at a higher price. So you go to market and sell it. You don't use the option. So what will happen to option? Option becomes zero. Zero value. So what is the total cash flow for the person 1? 65 rupees. Correct? Because from the sale of the share, he received 65 rupees. And from put option lapsed. So nothing comes out of it. Total cash flow 65 rupees. Imagine another person now. He purchased 12-month call option. He purchased 12-month call option means what? He has right to buy at 60 rupees. Now, after 12 months, if market price 65, what would happen? But uh, if he wants to purchase 60 rupees after 12 months, today he needs to have the money. How much money today he needs to have? Let's say rate of interest is 20%. I'm just assuming rate of interest is 20%. Invest present value of 60 rupees. Getting the point? After 12 months, you are going to buy the share by paying 60 rupees. 60 rupees after 12 months means today value is present value of 60 rupees, assuming 20% rate of interest. Present value, that is a discounting factor, 1 by 1 plus R. Present value comes to 50 rupees. You understand? If you invest 50 rupees today, after 12 months, I'll be able to purchase using call options. So after 12 months, if market price is 65, you deposit what you have 50 rupees that matures at 60 rupees, you have 60 rupees on with you. Now, where would you like to buy the shares? In the market, you can buy it at 65. In the options, you can buy it 60 rupees. So where would you like to buy? You would definitely buy it in the options, right? Or because it's available at cheaper price, 60 rupees you can buy in the market. Or you can say call option intrinsic value, market price minus strike price, 65 minus 60, 5 rupees you get. Okay, so total cash flow 65. Basically what happened? So we have two positions here. Person who purchased the shares and who purchased the put option, comparing it with person who have purchased a 12-month option and depositing his money. Both people have ultimately got same cash flow on expiry. They received same cash flow on expiry. Now, do you think both of their positions are same? There is one missing element in this problem which I have not considered. Or before considering that, can you tell me both of their inflow are same? No doubt about it. But today, their investment is not same. Are you understanding? After 12 months, what is their cash flow? Both are same. First person also gets 65 rupees. Second person also gets 65 rupees. But what is their investment today? What is their outflow today is not same. What is their outflow? That is, one person's outflow is 40 rupees. Other person's outflow is 50 rupees. That is not equal. So you can't say that these two positions are same. To make them same, to make these two positions same, we will consider one more element, which is the option premium. You can see in this situation, we have considered put option, premium we have not considered. We have considered call option, premium we have not considered. So how should the premium should be structured? The premium should be structured in a way that these two people's cash flow, who having two different strategies, their today's cash flow should be same and expiry cash flow also should be same. And how it is made same, that's how option premium should be. If that is not equal, if these two positions are not equal, then you have an arbitrage opportunity in one of the situations. I mean, nothing to write down. Just want to give you overall picture, interpretation part of it. Even if market price goes down, same discussion can be holds good. Let's quickly compare. If market price is 35, where are you going to sell your options? You will sell in the market or you sell in the options. Obviously, option is giving you 60 rupees. Therefore, even if you sell in the market at 35, options will give you intrinsic value at 25 effectively 60 rupees cash flow you get. In the second person situations, call option, when the market price is less, call option not exercised, so intrinsic value will be 0. Deposit anyway, you get 60 rupees, and therefore your value will be 60 rupees. So you see, whether market price goes up or market price comes down, your situation is same. Okay, so what this is trying to tell you, you buy the share and you buy put option, invest in risk free and you buy call option. These two positions will have same cash flow on expiry, but initial cash flow, that is cash flow at the beginning, is not equal. To make them equal, what we do is we are going to consider the premium. That's how this formula is constructed. You need not write it down. I just told you for your reference. Okay. There is one more way of interpretation which I would like to bring to your notice. Interesting interpretation. That is more practical and more realistic for trading purposes. Again, not so much for exam, but for trading purposes. Okay. Let me tell you that also. Okay, fine. Okay. Okay. Now let's just go one to one point backwards. In futures, in futures, please tell me, how do you think the payoff graph will look like? Payoff graph will look like a straight line. See, payoff graph will look like a straight line like this. Why it looks like a straight line like this? It's a linear line. There is no premium and all. If you take a long position, if market price goes up, you make profit. If market price comes down, you make loss. As simple as that, right? For different market price on expiry, as the as the market price goes up, long position gives you profit. As the market price comes down, that gives you loss. Simple as that. The payoff graph will look like this in futures. Okay. Now, do you remember in call options? In call option, how the payoff graph will look like for a holder? How the graph will look like, payoff graph for a call option holder, let's say C plus. So payoff graph will look like this. Again, x-axis is market price, y-axis is payoff. For a call option holder, remember the payoff graph, loss is limited to premium, profit can be unlimited, right? This is how the payoff of call option holder will look like. Now, do you remember how the call option, how the payoff of put option writer will look like? How the payoff of put option writer will look like? You can check the material for your notes. This is the market price. This is the payoff graph. Profit is limited. Profit is limited. But as the market price goes up, you start making losses, right? That is the payoff graph of option put option writer, P minus. Now just imagine if I mix the two, what would happen? If I mix these two positions, what would happen? You are a call option holder and put option writer. If mix the two, what do you think will happen in call option holder position? Will you pay premium or will you receive premium? in call option holder position. In call option holder position, you will pay premium. In put option writer position, what happens? Put option writer position, what do you think will happen? You will receive premium, right? You will receive premium. And as a result, what happens? The what amount you pay, what amount you receive will set off, and it will look very similar to this. That is what this theorem says. In the sense, what if you take a position on a security, a call option holder as well as a put option writer, and that is as good as taking the futures only. That's also called a synthetic futures. So those the future price, and here you are taking a position at a particular this strike price plus this call option premium what you pay, and put option premium what you receive. If I take a net amount, these two will be equal. If not equal, you can take an arbitrage opportunity. You can create an arbitrage. And that's one more theorem, one more way of explaining put call parity theorem. Again, you don't have to write it down, not required for examination. I just told you the interpretation could be like this. Just give me 1 minute. If I can, I would like to show it in a practical manner whether this really holds good. I'll just try it. Just give me 1 minute. Okay, not required now at this point in time. This should not confuse you. So what you need to keep it in mind is, if you take a call option position as well as put option position, call option premium as well as put option premium, that is equivalent to having a futures position on the underlying asset. That two things will be equal. If not equal, arbitrage opportunity exists. That's what you keep it in mind, sufficient. So ultimately, what is put call? I mean, this is the graph I want to just show it to you. I just showed you, right? How the graph will look like. I think I showed a little bit wrong. Okay, I think the graph I showed is slightly wrong. I'll just reconnect it. Futures was correct. Futures payoff graph was correct. This was the payoff graph futures. A call option holder payoff graph was also correct. Limited profit, unlimited profit. A put option writer I showed you wrongly. I'm sorry that I showed it slightly wrongly. I'll correct it now. So he will have an unlimited loss when the market price comes down, but as the market price goes up, you have a limited profit. This is the right position, right payoff of the put option writer. Now, when I mix the both, what happens? What you receive, this amount premium you pay and premium you receive will get set off. And as a result, when I combine the graph, what will happen? This upward graph will be there and this downward graph will be there. If I mix both, how does it look like? This yellow color will get cancelled, right? This portion gets cancelled. Ultimately, downside is there, the position of the writer. Upside is there, position of the holder. Ultimately, this will become same as futures. I hope you got the point. Basically, this theorem tells taking a position on futures is equal to taking a position on call option holder and put option writer. This must be equal. That is what I was trying to tell. You are a holder in call and you are writer in put. If I mix both the positions, that is equivalent to taking a position on futures. It should be equal. If not equal, there exists arbitrage opportunity. Okay, I'll just show one practical stuff to you. Let's see if you can calculate and understand yourself. Practically, does it work kind of thing? I'll just go to, let's say, can go to anything. Sensible option chain. Once again, I'll just share it. Uh, are you able to see the Google Chrome, Internet, the option chain in Sensible? It's processing. Let's say select Reliance. Okay, option chain. Option chain basically for a strike price, how are the premium will look like? I just want to show you that. Can we say protective put and bull call spread has the same effect? Why are we bringing bull call spread here? Bull call spread means you are taking a position at two different strike price, and we are talking about same strike price here. So there's no point in mixing the strategies here. There's only two simple strategies. You are having a call option holder and put option writer. Both are added. That's what I'm trying to tell you. That's all. We are not mixing anything else. Okay. So hope you can see this thing. The font is very small. Let's see if I can remove some columns. We'll take out intrinsic value. Take out delta. I'll make it as large. Okay, I think now this looks better. Slightly better, I would say. You have strike price. This is Reliance strike price. Let's say I'll take that easier number, 2000. What is the call option premium, put option premium can identify? Call option premium is 147.75. Put option premium is 11.1. 2000, 147.75, 11.1. Right? Can you see those numbers? Okay. Now at 2000, if you become a call option holder and put option writer, what do you think your inflow will be? Cash flow will be? You know what is the formula? Strike price plus premium, right? That is what the break-even point or market price is going to be. If you are a call option holder, 2000 is your outflow, 147.75 is your outflow because you pay call option premium, but put option premium you receive. So can you tell me the net position amount? 2000 plus 147.75 minus 11.1. Can you tell me how much you get? 2000 plus 147.75 minus 11.1. 2000 plus 147.75 minus 11.1. You're adding call option premium and subtracting put option premium. So 2000 plus 147.75 minus 11.1. 2136.65, right? 2136.65. Okay. Let me do one thing. Now let me try 2100. Same thing. Can you tell me what do you get? 2100. 75.7 is put up call option premium. 37.55 is put option premium. So 2100 plus 75.7 minus 37.55. 2100 plus 75.7 minus 37.55. You get 2138.15. 1 or 2 rupees difference. Now, if I go to the Reliance futures price, I'm not sure whether NSE website is working. You got 2136, 2138 approximately that, right? If I go to Reliance futures price, you can see it is closing at 2137. Can you see last price, or let's say close price around 2137? Hope you can see that number. That means there's only 1 rupee difference, and 1 rupee difference you can't do anything, because even if you take a position, brokerage transaction charges will take away everything. You understand? The position in options where you become a call option holder as well as put option writer is equivalent to taking a position in futures. If both are equal, approximately equal, parity theorem holds good, and you can see here how beautifully it holds good. You can check for one more. Let's try for 2200 whether we get a similar number here. 2200. Can you try? Can you do it favor for me? Please add the call option premium, subtract the put option premium. Call option premium 35.6, put option premium 97.3. So 2200 plus 35.6 minus 97.3 plus 35.6 minus 97.3. 2138.3. You see, that's almost 2138 only, right? You can try one more. Then we'll go back. 2300 also I'll try. 2300 plus 16.55 minus 179. Okay, 2137.55. See, you can see it's all about 2138, 2137, approximately 2138 only. You get the point? Practically, this theory has to hold good. If not hold good, you have a beautiful arbitrage opportunity, which at least I have not seen. Very rarely happening, but in a large scale, it won't happen. Okay, let's go back. Okay, so basically what I told you, my dear friends, put call parity theorem. Okay, let's just try to revise. Put call parity theorem has two strategies. That is, you buy the share and you buy the put option. You invest in risk-free security and buy the call option. Both strategy will have same cash flow and expiry date. But the initial cash flow is not same. To make it same, we have to bring in option premium. So option premium should be such a way that their initial cash flow should be same. That's how the formula is built up. Value of call plus present value of strike price is value of put plus current market price. Hence, basically, put call parity theorem links four variables: the current price of the underlying asset, put option premium, call option premium, strike price. If it is not hold good, that means there exists arbitrage opportunity. So you can quickly write down these 5 points for your reference. So if theory question comes, uh, you will be able to solve it. You will be able to write something. Then we'll write arbitrage opportunity. Of course, we'll discuss that. So you can write down these 5 points. 50 not visible. I thought sharing. It's not visible. Okay. I think it's not shared yet. I'll just share once more. Okay. So these are the 5 points. I'll just repeat once more. You can take it down or you can take a picture. You can take a picture also. It's not my handwriting. So you can read it later. But make sure you write it. There are two strategies. You buy the shares and the put option, or you invest in risk-free asset and you buy a call option. Both positions will have same cash flow on expiry date. But their cash flow initially is not same. So option premium should be such a way that their initial cash flow also will be same. This is the formula of put call parity theorem. And put call parity theorem links four variables: underlying asset price, that then put option, call option, and at a particular strike price. If PCPD does not hold good, put call parity theorem does not hold good, there exists arbitrage opportunity. So from exam point of view, what you need to keep it in mind? The formula and these 4 5 points. That's it. Nothing else required beyond that from exam point of view. Arbitrage, I'll explain you. Okay, so it is fine. Okay, so it is done. Okay, very good. Okay, now let us take an example whether put call parity theorem holds good or not. Let's say current an example I'll take it. Let's say value of call. Let's write the formula once plus present value of strike price, exercise price should be equal to value of put plus current market price, right? Suppose value of call is 20 rupees and strike price, let's say it is 1200 or 1120. Okay, and rate of interest, let's take it as 12%, and term, let's take it as 1 year. Rate of interest 12% and term to expiry, let's take it as 12 months, 1 year. And current market price, let's say it is 1005 rupees, and let's say this is value of put is 22 rupees. These are given. Okay, now if you apply this, do you think put call parity theorem holds good? What do you think in your opinion would happen? Okay, first, how do you calculate present value? Divide by 1 plus r. So this is 20 rupees plus 1120 divided by 1 plus r, 1 plus 0.1 equals 22 plus 1005. So 22 plus 1005, and that comes to 1027. And here this is 20 plus this is 1000, I think. So we say 1020. So 1020, 1027. So what do you think? Put call parity theorem exists or does not exist? Obviously, the number is not equal. So we say that PCPT does not exist. And PCPT does not exist means arbitrage. This is not equal. So arbitrage exists. Okay. So how do you construct the arbitrage strategy? Again, here I would like to tell you two processes. One process is theoretical, long process. Then what you can do in exam, I'll give you a shortcut. But shortcut I'll give you later. Okay, clear? Okay, first let me come to the theoretical parts. Regular process. First, what do you think? Remember, what is the first step we did in futures? In arbitrage construction? We did arbitrage strategy in future. Do you remember? How did we identify, or what is the first step in futures we constructed? Please refer the notes if possible. I'll give you 1 minute and try to tell me. What is the first step we have taken in futures arbitrage strategy? Remember, we took a position of either future sell or future buy. But how did you decide? Is it going to be sell? Or how did you decide? Is it going to be buy? How you made the decision? How you made the decision? Whether to go into future buy or future sell. Depending on overpriced or underpriced. Correct. That's all I was expecting. Nothing else. Whether it is overpriced or underpriced. Hope that much at least you remember. If overpriced, you sell. Underpriced, you buy. At least that much you should remember. Everybody. I understand. Entire thing you may not remember. Requires revision. But at least you would remember that that started with identifying overpriced, underpriced. The same thing I have to do it now. I have for a call option also. I have for a put option also. Let me do for call option. Same thing applies for put option. I'll show it to you later. Okay. So first check is whether call option overpriced or underpriced. Overpriced or underpriced. That's the first step. So what do you do? Use the put call parity theorem. That is value of call plus present value of strike price equals value of put plus current market price. Use this formula and compute the value of call as a balancing figure. Present value of strike price, we already calculated, it's thousands. Value of put is 22. Current market price is 1005. So what is the balancing figure? Please compute and tell me what would be the value of call. Simple, 1005 plus 22 minus thousands. 27, right? Simple one. 27. This is the value. This is the value. What is the price? That's how we always make a decision. Value versus price. What is the actual price? Value or theoretical value, let's say. Theoretical value of call option. What is actual price? Mean premium. Actual price of call, uh, 20, right? Actual price of call, 20. Price, 20. Price, premium. Call premium, 20. Now based on this, you please tell me whether it is underpriced or overpriced. Think from price point of view. This is the rule always. Don't think from both the point of view. Price, which is 20 rupees, is it less or more? That's all I'm asking. So 20 is less, right? This is less, which is underpriced. Less means underpriced. Underpriced means the decision, the decision will be to become a call option holder. Underpriced means you have to buy. You buy. And buy what? Buy call option. And when you buy call option, you become a call option holder. You become C plus. Call option holder, you become C plus. Okay. Just 1 second. Okay, fine. Just 1 second. Okay, fine. So hope you're written till here. Hope you have written till here. Yes. Okay, very good. So what are the transactions that you're going to do now is what I'm going to teach you today. And on expiry later I'll discuss. Okay. And one point in you keep it in mind. Arbitrage means I don't start with any money on hand. Zero money on my hand. Zero position. Arbitrage. Whatever I want to start, I'll always start from borrowing. Okay. So in call option, what is that we have told? You become a call option holder. That's what I'm telling you. You become a call option holder because it is underpriced. Underpriced means what? You're going to pay, right? How much premium? You're going to pay premium of 20 rupees. You pay premium of 20 rupees. This is the position. Okay. On expiry, what will happen? Two situations can happen. Market price more than strike price, market price less than strike price. Market price more than strike price or market price less than strike price. Two things can happen. Okay. If market price less than strike price, tell me what happens in call option. If market price is less, what happens to call option? Option will lapse. So zero cash flow, you can forget about it. Zero cash flow, you can forget about it. If market price more than strike price, then you will exercise and therefore you are going to pay the strike price and deliver one, get one share. You pay strike price of 1120 and you will get one share. Okay. Now you can understand settlement on delivery basis or settlement on net basis. Let me explain as settlement on delivery basis. Then when I go to the shortcut, I told you settlement on net basis. As of now, let's understand settlement by delivery basis. Fine. And as I told you, both answer will be same ultimately. Okay. Now, you please tell me. After expiry, I will pay 1120. How I get that money, I'll come to it later. I have one share with me. When? After expiry, after 1 year. That one share with me, what I need to do? Keep it in mind. Arbitrage means I start with nothing. At the end, whatever I have, I want to dispose of and I need to have a surplus cash with me. The surplus cash is my arbitrage gain. I should not have any uncertainty. I should not have any risk. If there is uncertainty, if there is risk, that's not called as arbitrage. Here, after expiry, I have one share with me. What do I do with that one share now? You may tell, you sell. At what price you sell? Sell at market price. If you tell sell at market price, that market price I don't know, right? That becomes uncertainty because I'm selling on expiry. The price I don't know. So that becomes confusing. I mean, that becomes uncertainty. Uncertainty means it's not arbitrage. So here comes a beautiful situation. Listen to me carefully. How you are going to dispose of, this one share, you're going to use it for repayment of shares. Repayment of shares. Which means today I'm going to borrow shares. So shares, I'm going to borrow. Borrow means what? I take a short position in shares. Borrow one share and sell it at current price, which is 1005. Are you getting the point? Today I borrow the shares. Basically, I take short position. I take short position. And once I borrow the shares, I sell the share in the market, I get the money. And after 1 year, I have an obligation now. I have to repay my share. Where do I repay my share? I don't buy from the market. I buy from this option. So from the option, what the shares I've got, I use it for repayment of shares. Such a beautiful portfolio. In the call option, I become a holder. In the shares, I become a short position, like a portfolio hedging, you can say. But anyway, so point is this: I'm going to have a share on expiry date. I don't want to sell in the market. That is uncertainty. So I'm going to use it as a repayment of shares. So for me to repay today, first of all, I need to borrow shares. So I borrow shares today, and after 1 year, I have to repay with the shares. I will not buy from the market. I buy from the call option to repay my shares. So that I am not worried about the market price movement. I get the share in the call option. I will give it to my short position from whom I have borrowed my shares. Any question you want to ask on this particular situation? This repayment of shares? Is it fine? Okay, now. Now tell me, once you sell it at 1005, what do you do with this money? If you remember what would happen in short position, remember, you have the money with you now. What do you do with that money? You are going to deposit, right? That money, what you are going to do is you are going to deposit. You are going to do deposit. Deposit the money. And this deposit, what happens? After maturity, deposit matures. How much amount I'll tell you. And deposit matures means you get the money. With the money, what do? You are going to buy the share. I told you, right? If you want to buy the share using all option, you need to pay 1120. Where you get that money? Where you get the strike price? You get the money from the deposit maturity. Okay. Everything works out fine if market price is more than strike price. Now tell me, if market price is less than strike price, will the call option be exercised? Call option will not be exercised, but you still have a liability, right? You have a liability to repay the share. Now you need to buy the share. Where will you buy the share from? You have already taken a short positions in shares. You have already borrowed in shares. Now you need to repay. You need that shares. Where do you get that share? You thought you'll get it from call option, but now call option lapse. Shares is not coming from that route. You say, I will go to market and buy it. You said market and buy it. That means uncertainty comes again. We don't want uncertainty. We don't want risk. If you have, you cannot call it as arbitrage. I know I have money, but I don't want to go to market. Okay, now tell me, in which instrument or which instrument is exercised when the market price is less? Which instrument is exercised when the market price is less? And that is put option. That is put option. Okay, put option. Now you please tell me, for me to square off the position short, I have taken a short position on shares. I need to repay my shares. I need to buy the shares for me to repay, or I need to sell the shares. I'm looking for buying the shares, right? Because I have to give it to my borrower lender. So should I become a put option holder, or should I become a put option writer? If I become a holder, I have right to sell the shares. First of all, I don't have shares. I'm struggling now. Where will I sell in put option also? In put option, I should become put option writer. So that when the market price is less, the option is exercised. So you should become a put option writer so that market price is less. Put option exercise not by you, by the other party. When market price more, no problem. Market price more, anyway put option lapse. Put option lapse, you don't worry about it. When the market price is less, put option exercised. So buy at strike price 1120 and you get one share. So pay 1120 because you have an obligation to pay now, obligation to buy the shares and get one share. So instead of buying the share from call option, you buy the share from the put option. And again, repayment of share happens, same process. You will have repayment of shares. Repayment of shares. Here also deposit matures, same thing. Deposit matures. And call option lapse here, put option lapse here. Okay. When you become a put option writer, you receive the premium, right? You receive the premium. How much premium you receive? Put option 22. Okay. Now, considering these things, what will be your net cash flow today? Net cash flow today. That is what I'm going to do deposit. Tell me how much cash flow you have. You pay 20 rupees. You receive premium 22 rupees. 22 rupees you receive. And you receive 1000. So what is the net cash amount you have? 22 rupees you pay. 20 rupees you pay. 22 I receive. 1005 I receive. 22. 1005 I receive. 22 I receive. 20 I pay. 1007, right? 1007. 1005 I receive. 22 I receive. So those two are plus. 20 I pay. So minus. 1007. So my deposit is actually 1007. My deposit is 1007. So when maturity happens, how much maturity? Interest rate, I think 20% I gave you. No, 12%. So multiplied by 1 plus 0.2, 1 plus 0.12, 1.12 you can multiply. That's the deposit maturity amount. 1007 into 1.12, 1127.84. Right? That is the amount. 1127.884. 1127.84. Okay. Now, but how much money I need? Whether it is for call option exercise or put option exercise, I need only 1120, right? Here also 1127.84 only. But I need only 1120. So what is my surplus? 1120 and 1127.84. 7.84 is my surplus in both the cases. 7.84 is my surplus. Okay. This to an extent is convincing, but remembering this process is definitely a nightmare. In the exam, put call parity theorem is not very popular, but still remembering this whole process, the connections, where do we start, where do we end is not so easy. But I had to tell you for the concept I told you. There is a beautiful shortcut for this. I am sure each and everyone will be able to follow it. And let me tell you with authority, this shortcut I have not seen in other books, other classes, other faculties. I have not observed, at least to my knowledge. So if something is coming to you, you have to make use of it. If you don't use, then what is the difference between you and others? In the sense, if you don't read books, then there is no difference between literate and illiterate, right? Ultimately, both are same. Anyway, so here, one more point of confirmation. Do you remember in the futures also I told you, if something is not equal, underpriced, overpriced, whatever the difference we find, that should be our arbitrage gain. If you remember, what is our difference we have found out here? 27 minus 20, 7 rupees, right? But here how much we got? Difference 7.84, something not matching. So round it off. No, no, it's not a matter of round off. I'll tell you, simple reason. Very simple reason. 7 rupee is the difference in today terms, in the sense it is present value terms. In future value terms, how much it is? 7 rupees present value. Adjust for time value of money. Multiplied by 1 plus R, 1 plus 0.12. How much you get? 7 into 1.12. 7.84, right? And that is arbitrage. Arbitrage should always tell you how much profit you get in advance, irrespective of what happens in the market price. It should not have any uncertainty. It should not have any risk. It is risk-less profit, certain profit. That is why it is arbitrage opportunity. Two things are not equal. We buy in one, we sell in another. And thereby we create arbitrage opportunity. Okay, now coming to shortcuts. Where the shortcut starts from? I told you put call parity theorem. LHS is not equal to RHS. What is the difference? Can you tell me? This equation, if you remember, 1020, 1027, 7 rupees the difference, right? Yes, that is my starting point in shortcut. Okay, so what is a shortcut? We are going to learn. Let us take a look at it. Very simple logic. I am sure you will be able to understand. Okay, so let me give you the shortcut now. So let's write the put call parity theorem. First, you write PCPT, value of call plus present value of strike price equals value of put plus current market price. So these four legs, I will call it as four instruments. This VC is a call option. Present value of strike price, you make it as money. VP is a put option. Current market price, you take it as shares, or you can take it as spot. I'll take it as share, underlying asset basically. Shares or underlying asset. Shares is an example. Do you remember in futures, I gave you three markets for you to remember easily. In futures arbitrage, three markets to remember easily. SFM, right? Spot market, money market, future market. Here also we have spot market, shares. Here also have money market. Futures I don't have. Instead of futures, I have call and put. Because we have two instruments at same strike price. Okay. Now the question comes, okay, where to take long, where to take short? Very simple. Two things can happen. If left hand side is less, or right hand side is less. Only two things can happen. If it is equal, arbitrage opportunity does not exist. Parity theorem exists. Only two things can happen. Let me say first situation, LHS is less or LHS is cheaper. Okay, now you tell me, if LHS is cheaper, what should I do? Something cheap means what should I do? Buy or sell? I need to buy, right? I need to buy. Obviously, that means right hand side I have to sell. I have to sell. Okay. Now, what are the positions today you are going to take? You are a buyer of a call. That means you become call option holder. You become call option holder. I'll write it as first point. These are all the positions today. Okay. Call option holder. Uh, money buying. Money buying means money with you. Or you can say long position. Buy means long position. What is long positions on money? Or what is long position is on asset side, liability side. What do you think? Uh, when I say long short, if you remember, balance sheet part also I told you. Remember, when I say long is my asset, right? Short means my liability. If you remember, buy sell you can tell, asset liability you can tell, long short you can tell. Anyway, so money is buy or money means so it's a long position. I will tell. Buy means long position you can say, or you can say asset. You are a buyer means you have an asset. You can say buy within bracket. You can say asset. Sell you can say liability. However you want to remember. So money what you are going to do, it becomes an asset. That means you are going to deposit. Put sell. When you sell put, what you become? Put option writer. Correct. Put option writer. And shares you sell. What do you mean by shares sell? What do you mean by shares liability? What do you mean by shares liability? You take a short position. You take a short position on shares. Short on shares. Basically, you borrow and sell. You borrow. And for you to remember, this call and put always opposites. This money and shares always opposite. Easy to remember. Okay, and these are all the transaction today, and consequence happens on expiry. That's not going to be a problem. When the problems you'll understand, we have done it already. Consequence will not be a difficult thing. Okay, hope this is clear. Simple shortcuts. Write the formula, see which is lesser. If LH is lesser, you construct the strategy today, and consequence happens. Call option exercise or lapse, put option exercise or lapse, deposit matures, short shares means you repay shares. Simple concept. Okay. Now let me go for other case. Just 1 second. Okay. Now let me go for the other case. Let's write the formula once. Put call parity theorem. Value of call plus present value of strike price is value of put plus current market price. And what we are trying to tell here, in this case, RHS is cheaper. Suppose RHS is cheaper. Okay, so first one we have is call. Present value of strike price we have is money. Value of put is put. Current market price is shares or spot. Okay, RHS is cheaper. So what should I do with respect to RHS? Since RHS is cheaper, that I need to buy. Buy you can also means like an asset or long position. If RHS is cheaper, what should I do with respect to LHS? LHS I need to sell. That is nothing but I can say liability. Short position. Okay, what are the positions now? You buy put option. So can you tell me what is the position? You buy put option means You become a put option holder. You become a put option holder. P plus. Okay. If you're buying the shares, buying the shares, investment in shares, buying the shares. Basically, can I say long position? Yes, buying the shares, nothing but long position. Now, what should I do with respect to the liability side? Liability call, in the sense I have to sell, sell call, seller of call. That means put option writer, sorry, call option writer, call option writer, C minus. And money, what do I do? Liability side money means I'm going to borrow money. Borrow money, liability side, no, that's why. And remember, put option holder and call option writer opposites. And buying the share asset side, borrowing money liability side opposite. And that should, you should always remember. Buying the shares means you need money, you are going to borrow it. In the previous case, you deposit money means you are going to short the share. Once you sell the share, you have money, you are going to deposit. So that way also you can understand asset and liability side. Buy, sell, asset, liability, long, short, however you want, you can understand. The key is writing the put call parity theorem clearly and which side buy, which side sell. And both the cases, difference, that is LHS minus RHS. This difference, whatever you get, multiplied by 1 plus R, or if it is continuous compounding, E per RT. Adjust for time value of money. E is arbitrage gain, shortcuts, verification. E is arbitrage gain. E is arbitrage gain. And in the exam, what you can do, if you're slightly confused, anyway this structure is there, you what positions you have done today, you know, and what profit you have to get also, you know. So write this number, then show it as if you get that calculation somehow. So you know the starting point, you know the ending point, fill it up, process, let them search it. I mean, you have to get it. In case you don't get, I have told you a shortcut, but use it for verification. Don't write this number as it is, you don't get marks. You have to show the process. So these are the strategies today, and these things will have a consequence. Okay. A few small points before I forget. I told you one thing. We have followed this process. Call option overpriced or underpriced. This process I don't follow. Still, I would like to tell you, you can also do this for put option. Just can you tell me? Can you tell me if this call option I put it as 20? What will be balancing figure in put option? Can you tell me the number? If what is the balancing figure in put option if I calculate? Don't write, just for your verification. Put the value of call as 20, but put option balancing figure. So 1000 plus 20 minus 1005. 15 rupees you get. So value is 15 rupees, but premium is 22 rupees. Price is 22. Price is high. High price. So what would have been your conclusion had you followed put option? It is put option overpriced. Price 22 rupees high. So put option overpriced means you would have become writer, and that's what you have become right here. You have become put option writer. Same consequence would have followed. I just told you, you could have done both ways. But anyway, so this is a shortcut we are going to do. And for this is nothing but we are buying a call option and we are selling a put option. So this is situation where, or this is applicable, where you can say call underpriced, give the heading for the first one, or put overpriced, both are same. Call underpriced or put overpriced. call underpriced or put overpriced. This is what will happen. In the second situation, call overpriced or put underpriced. Okay. So this is what would happen in this case. Okay. Let me give the format summary, what required for solving problems. Then we look at the problems. First situation, LHS is cheaper. What is LHS is cheaper? We have understood. Call underpriced, right? The first situation. Put overpriced. You don't remember all of them. I'm just telling you for your reference. One you remember sufficient. Put overpriced. What you're going to do? Transactions today. Transactions on expiry. You will have two situations: market price more than strike price, market price less than strike price. Four instruments: call, put, you have money and shares, or shares, money. So what I've written in call option, you become a holder, so I'll say C plus. In put option, you become a writer, C minus. In the shares, what you will have? Go to the first one. In the shares, you deposit. So money you deposit. Shares you are going to short. So shares you are going to short, and money you are going to deposit. So premium you pay premium. This here, sorry, put P minus, not C minus, P minus. Put writer. So you receive premium here. In short position, you are going to receive money, right? Because you sell the shares. You short position means you receive money, borrow and sell the shares, borrow shares and sell it. And whatever money you receive, deposit. Net deposit. Why net deposits? Because some cash flows are outflows, premium, some are inflows, and sell the share you receive money. So net deposit, you are going to put into deposit. Net amount in deposits. Okay, now, if you understand settlement by net basis, settlement by cash basis, I would recommend that for examination, go for settlement by net basis. You can assume a market price and give the solution same under both the cases. Okay, what will happen on expiry? Now, please tell me, should I take payoff or should I take intrinsic value? Intrinsic value is market price minus strike price. But should I take that payoff or should I adjust for the premium for me to do the cash flows on expiry? What do you think? Okay, I would tell don't consider premium. Why don't consider premium? Because in the net deposit it's already reflected. Again, if you subtract premium, that will be a duplication. Normally, we go for payoff. Intrinsic value, adjust it for premium. But premium is already adjusted in net deposit now. So you should not take in two places. So don't take a payoff, just take the intrinsic value. That is what? Market price minus strike price. Intrinsic value you will receive when market price is more. What will happen if market price is less? Zero, because option lapse. Option lapse. Okay, put option, if market price is more, that will lapse, zero. And what will be the intrinsic value here? Please be very careful. Intrinsic value will be here because you are a writer. For a holder, what is the formula? Intrinsic value. For a holder, intrinsic value is strike price minus market price. But for the writer, either I put the negative number or I'll make it as market price minus strike price. Basically, this will become negative. Because you are a writer basically. Sorry, for a put option holder, you can say either ways, strike price minus market price or market price minus strike price. Basically, this number becomes negative. And this becomes negative. Okay. On the shares, in both the cases, you buy at market price. Because this is on settlement by net basis. That's why you go to market price, you buy at market price and repay shares. And here also you buy at market price and repay shares. And net deposits, a deposit matures. And here also deposit matures. Ultimately, whatever surplus cash, here surplus cash, here also surplus cash, that represents arbitrage gain. And that is known in advance, I told you. Arbitrage gain. Of course, when I take up the numbers, it should be more convincing, but still, this format should be for your reference on day before exam. Ideally, you should not even remember this part. Just the shortcut I told you. For LHS cheaper, RHS cheaper. That's all you need to keep it in mind. Right. So just as a practice, initially, I'm making you write this so that when you take problems, it will be more smoother. Fine. Okay. Let me just do the one more also. RHS is cheaper. Means call overpriced. Means put underpriced. Call overpriced, put underpriced. Same situations. So what do you do today? What do you do on expiry? On expiry, two situations you should cover. Market price more than strike price. Market price less than strike price. 4 positions. Call, puts, on shares, on money. So in call, what we discussed, you become a writer, I think. In put, you become a holder. In shares, I think you take a long position. That means you buy. And money, I think you're going to do a short. That means you're going to borrow. This was the positions today. So when you're a call option writer, you receive premium. A put option holder, you pay premium. On shares, you are going to long. So you buy the shares. And you buy the shares means you need to borrow money. Then market price more or less, what are maybe the things? Borrow money means you have to repay money along with interest, of course. Buy the shares means you have to sell the shares at market price. Sell the shares at market price. Here also you sell the shares at market price. It is also settlement by net basis, okay? Settlement by net basis. What will happen on expiry with respect to the options? You receive, okay, call option writer. Now, please tell me, is call option exercised in the first situation, market price more than strike price? It is exercised. But what will happen to intrinsic value? Intrinsic value becomes negative for you because you are a writer, right? So what is the formula for uh, call option intrinsic value? Market price minus strike price. But here I'll make it as strike price minus market price, intrinsic value. Or basically this becomes negative because you are a holder. If market price less, call option lapses, nothing to worry. For put option, market price more lapse, nothing to worry. Put option holder, market price less, you receive the intrinsic value. Intrinsic value is strike price minus market price. This is positive only. You are a holder. Positive. And don't take premium because premium would have been already considered. So that's it with respect to put call parity theorem and arbitrage. Hope you got the concept and the shortcut. Okay, last one. Surplus cash is whatever you get. Surplus cash. Here also surplus cash. The surplus cash is arbitrage gain. Arbitrage gain. Okay, hope you got it. Any questions? Okay, good. Okay, hope everybody's back. Let us do this problem now. Okay, hope you got this question. We have discussed what is put call parity theorem and the arbitrage techniques. From the exam point of view, this has not come very frequently, but chances are there definitely. So we'll take up this problem. We'll understand both the scenarios here. Following information is available for 3 months call and put option, stock of CAT Limited. Price of stock, that is current market price, strike price, value of 3-month call, value of 3-month put, basically call premium, put premium, interest rate 10% continuously compounded. Check whether put call parity exists. If not, construct arbitrage strategy. If the value of put option is rupee 1, reconstruct the arbitrage strategy given e power 0.025 is 1.0253. So when they give you e value, we should go for continuously compounded. And anyway, question also very specific, compounded continuously. Hope you got the question. Okay. So first, let's put the put call parity theorem into place. So using the put call parity theorem, value of call plus present value of strike price is value of put plus current market price. So value of call 3 rupees. Present value of strike price. You know how do you calculate present value? Future value divided by 1 plus r, but e value is given. So I will be calculating like this: future value divided by e power rt. Okay, future value divided by e power rt or multiplied by e power minus rt if they give minus. Strike price is the future price, which is 30 rupees divided by e to the power of r, rate of interest 10%, 0.10 for 3 months into 3 by 12, I think. Yeah. Equals value of put, that is 2.25 plus current market price, spot price 31. So that is 3 plus 30 divided by e power 0.025. And e power 0.025 given 1.0253. Strike price 31 divided by e power 0.10 into 3 by 12. put option 2.25. Yes. Just give me 1 second. Okay. Hope PPT still visible. Okay. So 31 divided by e power rt 0.10 into 3 by 12. Okay. So value of put option 2.25. Current market price 31. So 3 plus strike price is 30. Okay. 30 divided by this is e power 0.025, and that is given as 1.0253, I think. So I'll use 1.0253 equals 2.25 plus 30. So this is 3 plus 30 by 1.0253. 29.26. 2.25 plus 31. I think this is 32.26. This is 33.25. So not equal. So it is not equal. So put call parity does not exist. Put call parity does not exist means, arbitrage opportunity exists. Arbitrage exists. Arbitrage exists. Then you have to identify which is cheaper. Now, can you please tell me, for you to do arbitrage strategy, we don't have to worry about underpriced, overpriced. We will reach that, but through our shortcut. So, what is this strategy going to be? 32.26. So, left hand side is cheaper. So, LHS is cheaper, and obviously RHS is costlier. Okay, if LHS is cheaper, so what should I do with respect to the options? Since LHS is cheaper, call option I need to buy because that is cheaper. Cheaper means you have to buy, and costlier means you have to sell. So call option you become holder, and the present value of strike price. What do you do with respect to money? Money will be buy. So call buy. Okay, I'll write separately. Or you have written till here, or I'm not sure whether I can keep written here. And let's try to write it here itself. So with respect to call, you become holder because you buy. With respect to money, also you are going to buy. What do you mean by buying money? You are going to have deposit money, asset side. And right hand side, you are going to sell. So put option, you are going to become writer, put writer. current market price, that is on shares you are going to sell means you are going to borrow, short sell shares. Hope this shortcut will help you, easy to identify. Anyway, so let's discuss transactions today. Then transactions on expiry after 3 months, I think. So after 3 months, that is expiry. We'll discuss about two situations: market price more than strike price, market price less than strike price. So two things I can take it: market price more than strike price, market price less than strike price, and we'll have to prove in both cases we get the same answer. Market price more than strike price means how much? What is strike price? 30 rupees. Let's take 35 rupees. 35 rupees, which is more than 30 rupees strike price. And another one, let's say 25 rupees, less than 30 rupees. Any number you can take, just for proving the purpose. So whatever instruments we are having: call, puts, on shares, money. Okay, so what we have just written: on call, you become a holder; on put, you become a writer; on shares, it's going to be buy, which means you are going to on money you're going to deposit; on shares you're going to borrow and sell, that is basically short position; money you're going to deposit. So you holder means you pay premium. How much is your call option holder premium? 3 rupees. Writer, you receive premium. You receive premium of 2.25. And you borrow shares and you sell at current market price. So sell at current market price, therefore you receive, sell at current market price, you receive current market price of 31. So what is going to be net deposits? 3 rupees you pay, 2.25 you receive, 31 rupees you receive. Receive you keep it as plus, what you pay you keep it as minus. So 31 you receive, 2.25 you receive, and 3 rupees you pay. 31 rupee you receive, 2.25 you receive, 3 rupees you pay. 30.25, right? $30.25. $30.25. Okay. First situation, market price is 35, strike price 30. Okay, let's do settlement by net basis. Okay, settlement by cash basis. Settlement by net basis. Market price is more, call option exercised. So you will have an intrinsic value of market price minus strike price, that is 35 minus 30. You will receive plus 5. You will receive plus 5. What will happen to put option? Put option, when market price is more, put option will lapse. 0. Put option will lapse. You borrowed the shares now. You are going to repay the share. For repay the shares, you buy in the market. You buy at current market price, or how much happening in the current market price? 35. And repay shares. So the 35 rupees is going to be plus 35 or minus 35, because you are paying the money, right? So this is going to be minus 35, right? Because you are going to pay the money, minus 35. And my deposit matures. So 30.25, you can multiply it by 1 plus R. That we already know. 1 plus R, E value 1.0253. You can multiply 1.0253. 30.25 into 1.0253. 31.02, right? 31.02, can I say? 31.015. Okay, 31.02. Okay. So now what will be your positions? 5 rupees inflow, 35 rupees outflow, and 31.0 rupees inflow. Deposit mature means inflow. So what is the surplus amounts? 5 minus 35 plus 31.02, you get 1.02. Let's see if you get the same answer in the next column also. When the market price is 25, market price is less. When the market price is less, what will happen to the call option? That will lapse, so 0. Now put option is exercised. By whom? The holder. He will get the benefit. For you, intrinsic value will be negative. What is the normal formula in put option? Intrinsic value, we say strike price minus market price. Strike price is 30, market price 25. So we say 30 minus 25. But this is for a writer, so it should be negative. Or you can say 25 minus 30. That is market price minus strike price. You get minus 5, intrinsic value. Because for a writer, intrinsic value will be minus. Remember it, minus 5. And here you buy in the market. Buy at market price 25 and repay shares. So you have minus 25 here, minus 5 here, and deposit matures here also, and you receive 31.02. So what will be the net amount here? 31.02 you receive, 5 rupees you pay, 25 rupees you pay, 1.02 is the surplus. Same surplus, 1.02. Verification, is the 1.02 correct? Let's quickly go to the thing. What was the difference we found out here where we identified parity does not exist? Difference is 0.99, I think. Right? 0.99. That is 32.26 minus 33.25. Adjust with time value of money multiplied by the E value there into 1.0253. What do you get? 0.99 into 1.0253. I think you get 1.015, round it off, you get 1.02. And that is what we are getting, surplus 1.02. Is it done? Okay. One more part of the question is there. If the value of put option is 1 rupee, reconstruct the arbitrage strategy. Let's do it. That situation. If put premium is rupee 1, what is the first step? We are going to start with the put call parity theorem. value of call plus present value of strike price is value of puts plus current market price. We are rewriting the formula so that we are getting used to that. Value of call, 3 rupees. Present value of strike price, we have already written it. Let's not calculate everything again. We already calculated 29.26. Value of put, the one amount we got it now, 1 rupee, and current market price is 31 rupees, right? 31. So this is 32.26. This is 32. So now, obviously, parity theorem does not exist. Which is cheaper? But if I consider here, the RHS is cheaper and left hand side is costlier. So what and all we should do when something is cheaper? Put option, you have to buy. Cheaper means you have to buy, and costlier means you have to sell. Nothing but you can say like a buy means assets, sell means liability. So a cheaper put option you have to buy. So you become a put option holder, put holder. And current market price you buy. That means you buy shares. That's all. You buy shares. You buy shares. Okay. Coming to LHS, call you have to sell because costlier. So you become a call writer. And with respect to strike price, money, it is sell. Money is sell. That is basically liability. So you are going to borrow money. And told you put option, call option should be always opposite. And buy shares means borrow money. So that is one asset, one liability. Okay, hope it is taken down till here. Okay, let's do the arbitrage strategy. Same format, transactions today. After 3 months, that is expiry. And let's do settlement by net basis. Two situations, market price more than strike price, market price less than strike price. So one number will take it as 30 rupees, 35 rupees, which is more than 30 rupees strike price. Other number will take it as lesser number, 25 rupees less than 30 rupees. You can take any number. So what are the instruments? Call, puts on shares, on money. Call, you become a writer. Put, you become a holder. Shares, you're going to buy. Money, you're going to borrow. So call writer, you receive premium, 3 rupees. Holder, you pay premium. This is minus 3 because sorry, plus 3 is fine. But you hear holder, you pay premium. That is 1 rupee. So minus 1 I can say. Shares you buy. Shares you buy at current market price 31. And therefore you are going to borrow rupees 31. So after 3 months, okay, what is the net amount? Net, sorry, no, not borrow 31. Borrow net amount. Borrow net, not 31. Net amount. How much is the net amount? premium 3 rupees you receive, shares you buy minus 31. But shares you buy at current market price 31. Buy means you have to pay. So minus 31. This is plus 3. So plus 3 minus 1 minus 31. How much you get? How much you get it? Plus 3 uh, 31 3 minus 1 3 minus 1 minus 31 29. 29 minus means you have to borrow. So borrow 29. I'll make it as plus 29 so that it becomes 0. That's what the net position should be. So you have to borrow 29. After 3 months, if market price is more than strike price, call option is exercised. So you get intrinsic value. Market price minus strike price, 35 minus 30, 5 rupees. But that 5 rupees will not come to you. You're not the holder. You are the writer. You have to pay that premium. You have to pay that intrinsic value. Or you can say strike price minus market price, the 30 minus 35 minus 5. For the writer, intrinsic value will always be negative. Of course, if option lapse, it becomes 0. Put option, it becomes 0. Market price is less. Put option lapse. Option lapse. And earlier you bought the shares. Now you're going to sell the share at current market price on expiry. Sell at 35. So you receive 35 basically. And you borrow earlier. So you repay 29 into E value 1.0253 along with interest. So you repay 29 into 1.0253, 29.7337, 29.73. Okay, this is minus. You repay 29.73. This is minus. 35 you receive, that is plus, and minus 5. So what is going to be net amount? 35 you receive, 5 rupees you pay, and 29.73 you pay. 0.27, right? Surplus 0.27. There is one more opinion. Some people might confuse like this. I sold the shares at 31. I bought the share. I mean, buy the share at 31. Sold it 35. Should I make 4 rupee profit? Now, don't go by net basis. Don't go by profit basis, because if I do that, borrowing and repay, I should take only interest. I'm taking cash flow, right? So don't take 31 minus 35 4 rupee difference and all. You can do, but we are not following that approach. Take cash flow approach. So 31 you buy, and here you sell at 35. So 35 I'm selling, 35 rupees receiving, and here I'm repaying 29.73. So I'm full cash flow 29.73 I'm taking. I'm not taking only the difference. Okay, let's do it here. What will happen? If market price is less, call option lapses 0. If market price 25, in put option holder, market price is less, option exercised. When market price is less, put option exercised. And what will be the intrinsic value you get? Strike price minus market price, 30 minus 25, 5 rupees inflow, because you're a holder. For the holder, intrinsic value comes in. For the writer, intrinsic value goes out. And here you sell in the market price. So you sell at market price of 25 and you repay same amount, 29.73. Since you repay, it's going to be minus. So net amounts, 5 rupees inflow, 25 rupees inflow, 29.73 outflow, same number you get 0.27 surplus. And does it match with the verification technique? What was the difference between these two? 32 and 32.26, 0.26 is the difference. Adjust for time value of money, multiplied by 1.0253. I think you get 0.27. 0.26 into 1.0253, you get 0.266, 0.27. So verification is also done. So that's about put call parity theorem, arbitrage, and a problem where we have done both the ways. I mean, both things cannot happen in exam, only one can happen. But what both ways we have discussed in this problem. Done? Any doubts? Okay, very good. Let's go further. Okay. Uh, let us do a problem on this arbitrage now. So come to this problem. Come to this problem. Here we get the both the varieties. The following table provides the price of the options on an equity shares of X Limited and Y Limited. The risk-free rate is 9%. You as a financial planner are required to spot any mispricing in the quotation of the option premium and stock price. Suppose if you find any mispricing, then how you can take advantage of this pricing decision. X Limited, Y Limited, exercise price, share price, call put. Hope you're able to get this question. Okay. Let's do for X Limited now first, then we go for Y Limited. So for X Limited, the pricing mismatch can be applied by put call parity theorem. So applying PCPT, applying put call parity theorem, value of call plus uh, present value of strike price, value of put plus current market price, value of call. Call option premium for X Limited, call option premium, call price means call option premium 56. Strike price, present value of strike price is exercise price 100 divided by, if E value is given, I would have done continuous compounding. Since E value is not mentioned, I'll go for simple interest. For 6 months at 9%. So 1 by 1 plus R present value. So 9% for 6 months. So into 6 by 12 equals value of put. Value of put option premium 4 rupees and current market price 160. Let's calculate this. See if it is equal to, this is 56 This is 100 divided by 0.09 into 6 by 12 means 0.045. So 1.045 equals, this is 4 plus 160, so 164. So how much left hand side coming to? 100 by 1.045 plus 56. 100 by 1.045 plus 56. 151, right? 161. 151. 161. 151. Okay. So 151.69. So 151.69. And this is 164. So not equal. So there is a price mismatch. So there is price mismatch. There is price mismatch. So arbitrage exists. Arbitrage exists. Arbitrage exists. Okay, then we'll have the columns like markets, transactions today, transactions on expiry. In this case, term is 6 months. So after 6 months, expiry. But shouldn't the strike price be equal? Strike price equal to what? We always look at the left hand side of the equation with right hand side of the equation. That's all. We are talking about two different situations. X limited separate question, Y limited separate question. We are not comparing the two at all. X limited separately, later we do for Y limited. We are not doing any strategy here. This is arbitrage opportunity. Okay, so markets, we are having call, put on shares, on money. Okay, now 151.69. So this portion is less and this 164 is more, which means the left hand side is less. This need to be purchased by, and this needs to be more. Means this has to be sold. Okay, so call option today is buy. So you become a holder. And you become holder means what? You have to pay premium. Holder, you pay premium of 56 rupees. For put option, it is sell. So you become a writer. So you receive premium of 4 rupees. Now on shares, what is the position on shares? Current market price, sell. So it's going to be short position. So borrow and sell. At current market price, how much? 160. So money is going to be buy. Now buy means what position? Can you please tell me? Buy means long. So what is the meaning of long position on deposit, on money? Deposit or borrow? I hope you remember balance sheet approach to remember easily. Balance sheet, asset side means deposit. Liability side means borrow. I told you, balance sheet format. On money, it is long position. Long position means like asset side. Long is asset side, short is liability side. Balance sheet approach. Easy to remember. Now, on money, because it is asset side. Asset side means what? Asset side means it is going to be deposit. And other way around. Because you sell, once you sell the money, you get it, right? That is to be deposited. How much going to be deposited? Not 160 rupees. You receive 160, correct. You receive 4 rupee, correct. But 56 rupees you have to pay, right? You have to pay. So what is the net cash? Deposited net amount. 160 rupees you received. 4 rupees you received. 56 rupees you have to pay. So net deposit 108. Okay, net deposit 108. Now, after 6 months, if market price is more, if market price is more than the strike price is 100. If market price is more than 100, you are going to exercise call option. Exercise call option. At how much amount you are going to pay? You are going to pay strike price 100 rupees. You are going to pay. If market price less, call option not exercised, but put option gets exercised. Put option writer, you will pay. If market price is more, if market price is more, put option not exercised. If market price is less than 100, exercise put option. Other party will exercise, he will sell, you have to buy, exercise put option at 100 rupees strike price, you will pay. Sir, are you paying both call and put? No. If market price is more, call option you will exercise. If market price is less, put option will exercise. Either of them, only one of them will be exercised. Either call or put. But in both cases, you pay only 100 rupees strike price. Settlement on delivery basis. Okay. Earlier you borrowed and sell. Now you repay the shares. Purchased above. Repay the shares. Purchased above. Either in call or in put you would have purchased. In both cases you would have purchased. Call option holder you would have purchased. Put option writer you would have purchased one of them. Use that shares and repay. That share position is closed. This deposit would have matured along with interest. Deposit matures along with interest. How much amount on 108? Multiplied by 1 plus R. 1 plus rate of interest 4.5, 0.09 for 6 months. So 108 into 1.045. You get 112.86, right? 112.86. Okay. So what is the net cash surplus? You paid 100, you receive 112.86, deposit matures, you receive. So net amount surplus 112.86 minus 100. Which is 12.86. That is your arbitrage profit. And I told you, arbitrage profit means riskless. That's what happening. We are not worrying about market price. We are getting the same profit. Either through call option exercising or through put option exercising. But we are getting confirmed profit, 12.86. And we should also be able to calculate. Let's see if you are able to calculate this number earlier. Now, please tell me what was the difference between these two numbers when there is a price mismatch? 151.69 minus 164. What is the price difference? It is 164 minus 151.69, 12.31. 12.31, right? Difference. But number is not matching. 12.31 here and 12.86. Sir, closer. Close is right, but we want to be more accurate here. How? This difference what you got is in present value terms. The profit what you got is after 6 months. So for 12.31 multiplied by 1.045, the 1 plus R, 9% into 6 by 12 means 4.5%. So 12.31 into 1.045. How much you get? 12.31 into 1.045. Hope you get the exact amount, 12.86. Verification. So you know, even if you don't know this strategy, ultimately what amount you should write, you know now. Then in examination, make it look like you got some amount like that. That's the beauty of arbitrage. Even though with so much circus, profit ultimately we know. It's like without even consolidation, we know balance sheet total. Like that. We know the amount to get even after all the process. So that's the advantage of this paper if you know the concept clearly. There is complexity, but there is simplicity also. Okay. Now this what we did now is settlement by delivery basis. I can also solve this on settlement on net basis. Let me do that also. But before that, please confirm you understood this and let me know if you have any doubts. Because when somebody solves it in class, it's very, very comfortable. And one complaint people have against me in my classes. Sir, in your class, things are usually complicated. In others faculties we have seen, it's very, very simple. At least in class we understand. In your class also, we get slightly confused. In your class also, you are going in a slightly higher speed. One of the common feedback I got. The reason is I always solve institute questions. I don't go beyond institute questions. And other faculties, I'm not going against them, but in general, the feeling is you solve easy problem in the class. Simple basics, which is right in a sense. So you feel comfortable. That was the intention. It's completely fine. But you are professionals. We should not teach you very, very simple things. You need to be expected to be at that level. And examination, that's the expectation. So in class, everything is simple. And in examination, things gets complicated. You don't know how to face it. So that's why I always solve the institute questions, slightly complex problems in the class. So you get uncomfortable, but you get used to be uncomfortable. You should get used to seeing complex questions. SFM paper latest. Again, I repeat, this is, I don't know what I told you earlier. Confidence in life. Just one simple example I give. I don't know that I go earlier. When a bird sits on the branch of a tree, it has confidence. What confidence? Not that the branch will not break. It's the confidence with itself that it can fly whenever it wants. Similarly, when you say a student has confidence, does not mean you have solved all the question. Does not mean you know all the answers. It just means I know I have the capacity to face any questions. So what is the meaning of purposeful life? Does not mean you don't have problems in your life. Not facing any problem is not the fun in life. You know how to face it. That is confidence. So if you have that confidence, any difficult question that comes in exam, you'll be able to face it. Any bouncer, let it be, you'll be able to face it. Any difficulty questions in life, you'll be able to face it. Any complicated government department, complicate the client, difficult situation, corona situation, whatever it may be, you'll face it because you have that confidence. And that's what CA articleship also teaches you. Many people have complained, we are not getting enough salary, we are not having these problems. All these are fine. Yes, they are all true. But you are getting a confidence that I can face any situation. That nobody teaches you, but you are learning unconsciously, subconsciously. Anyway, so I don't know what the point went difference of whereas that is some of your telling SFM paper is difficult in last exam. That's what I was telling. It's not about solving all the answers in the class. It's not about solving everything you also. But when you solve, try to learn the concept such a way that you get the confidence to face the problems. As long as you have that, I can face any questions, you will be able to perform rightly in exam also, in life also. Okay, so this is the settlement on delivery basis. Let me just quickly tell you, in the exam this much is definitely accepted, but I'll just go one step further. Settlement on net basis. If you explain settlement on net basis, again, so for same thing only I'm doing. So strategies are same. So markets today and after 6 months, that is on expiry. Okay, now whenever we want to settle on net basis, if you remember in futures also we did. If you want to settle on delivery basis, market price is not relevant. But if you want to settle on net basis, we need to assume something. Remember, on expiry date, we assume one number. Actually, we assume two numbers and we prove under both the numbers, we get the same answer. Hope you remember that concept. Same thing will be applied here. If you want to settle on net basis, settlement on delivery basis, no such assumption here. So we'll assume two situations. If market price is more than strike price or market price is less than strike price, and both situations will prove we get the same profit. That is arbitrage, riskless profit, uncertain profit, guaranteed profit. How much is strike price? Strike price was 100. Let's take two situations. Market price greater, which is market price is 100, 110. Strike price anyway 100. And here market price, let's say lower number. Market price is 90 and strike price anyway 100. So in one situation, market price is high. Other situation, market price is less. So 110, 90 assumed. They are assumed. You can assume any number. You are assuming two situations, one higher number, one lower number. Beyond market strike price, below strike price. Okay. So transactions today in call. Transactions today in puts, on money markets, on shares. Okay, the transactions today, everything will remain same only, repeat. So holder, you paid 56, being a holder, you pay premium 56. Writer, receive premium 4. Writer, receive 4. On money, you borrow 160. Sorry, oh yeah, shares. So I've written opposite. Sorry, this is opposite, no? Shares and then money. Shares, then money. Okay, so shares you borrow. That is short sell. And money you deposit. Or you can remember one more shortcut. Shares and money are always opposite. Call and money are always opposite. On call, holder means put writer. Call and put are always opposite. And shares and money are always opposite. On shares I borrow means money I deposit. On shares I deposit, that invest means money I borrow. Opposite. Two markets are opposite. You'll be able to remember it. So deposits, as we calculate here already, 108 net. This is short sell at 160. Okay, this is transactions today does not change. Even in futures also, transaction today does not change. Now after 6 months, settlement on net basis under two scenarios. Under two scenarios. Okay, now market price is more than strike price. Call option. Do you think it will be exercised? Call option holder, market price is greater, definitely it will be exercised. Therefore, you will have intrinsic value at 110 minus 100, market price minus strike price, which is equal to 10 rupees. Put option, what happens when market price is more? Put option will lapse, so no intrinsic value, 0. Now, earlier you borrowed the shares, now and you sold it. Now you buy in the market and you have to pay that. So buy in the market. Hope remember, long position means buy first, sell later. Short position means sell first, buy later. So buy in the market at market price is 110 rupees. And deposit matures. We already calculated. Deposit matures at 112.86. So what are the inflows, outflows here? This intrinsic value is inflow. Buy at 110. This is the outflows. So this is inflow. 10 rupees inflow, 110 rupees outflows, and deposit matures inflow. So what is the overall surplus? 112.86 minus 110 plus 10. I think you get same number, 12.86. Overall surplus 12.86. Okay. Next, if market price is less, what will happen to call option? Call option will lapse. Call option will lapse. So intrinsic value becomes 0. This will lapse. Now, put option will be exercised. And what is the intrinsic value for put option? Intrinsic value for put option will be market price, strike price minus market price, which is 100 minus 90, which is 10. But even though 10, I'll write it as minus 10. Hope you understand why I'm writing minus 10. I know intrinsic value is 10, but I'll write as minus 10 because you are a writer. Writer will have always intrinsic values negative position, minus outflow. Okay. Then borrow, you buy in the market for this short position. You buy in the market at the rate of 90. This is also outflow. So minus 90 I can say. And deposit matures. At 1112.86. This is inflow plus. So this is outflow minus. This is outflow because by purchase you pay the amount, and this is inflow plus. So what is the overall surplus will be? Again you will get same number, 12.86. So you can see whether market price is up or market price is down, your answer is same. Even if you show under delivery basis or settlement, net settlement basis, answer is same. And this can be computed originally itself by way of difference between the price mismatch and adjusted for time value of money. Okay, let me go further. Hope you're done here. We did for X limited. Now let's do for Y limited. Let's start fresh. Value of call plus present value of strike price equals value of put plus current market price. Value of call for Y limited. Call option premium 26 plus present value of strike price. Strike price is 80, 9%. I think directly I can divide by 1.045. Hope you're able to understand. In the previous link we calculated 1 plus R into number of months by 12, 1 plus 0.09 into 6 by 12. No, not 6 by 12. Sorry, this is 3 months, right? This is 3 months. So it will be even the one. Okay, let's calculate. It will be 0.0225. Let me show it anyways. Plus 0.09 into 3 by 12. This is 3 by 12. Net basis in option means we only receive intrinsic value, no concept squaring off. No, intrinsic value means squaring off only. When you receive the amount in intrinsic value on net basis, that is done with the help of square off only. The squaring of concept was not really required too much, or not covered it, not required. Unlike futures, the squaring was very important. Here, it means that you buy a future options, or you buy a call option, later you sell it, when you do a close it will happen squaring off automatically. So the intrinsic value means it will happen in square off only. So whenever we say net basis, it is squaring off concept. Okay. So value of put option 2 rupees, current market price 100. Okay. So this is 26 plus this is 80 by I think 1.0225. 102. So 80 by 1.0225 plus 26, 104.23. 24. Okay, 104.24 equals 102. So it is not equal. Again, there is a price mismatch. Okay. So arbitrage opportunity exists. Okay, fine. So markets, transactions today, transaction expiry, transactions today, we just say today, on expiry, call, put, then on shares, that is spot market, money. Shares means underlying asset here. That's what it means. Okay. So 104.24 is high. 102 is less. Therefore, the left hand side is going to be sold. The right hand side is going to be bought. Buy and sell. Okay, so value of call is a sell. Value of call sell. So on call option you become a writer. And the put option buy. So you become a holder. On share CMP buy. So buy means you take a long position, you buy. You take a long position, you buy. Okay. On money, can you please tell me? Many people have confusion on this money only. On money, you are selling. Selling means short. What do you mean by short position? In balance sheet, assets and liabilities, asset side is long, liability is short. So money will come on liability side. That means borrow. And you can always understand shares I am buying on the asset side. So money will be borrowed opposite side. To buy the share, you need to borrow money. However you want, you can think call and put are always opposite. Shares and money are always opposite. Okay. Writer, so will receive premium of 2 rupees. Holder, sorry, call option receive premium 26 rupees. Okay. Put option holder, you will pay premium of 2 rupees. And shares, you would like to buy. You buy in the market at spot price. You buy at 100 rupees. And borrow, what is the net amount which is borrowed? 100 rupees you need, 2 rupee you pay, 26 you receive. So 26 you receive, 2 rupee you pay, so minus 2. 100 rupees you pay, so minus 100. What is the net amount? 26 minus 2 minus 100. How much you have to borrow? $76, is it? Okay, 76. 76 is the amount you have to borrow. Okay. On expiry, let's understand settlement on delivery basis sufficient. Net anyway we understood. Settlement on delivery basis. So call option exercised if market price is more than strike price. And tell me, will you buy or will you sell? If market price, if call option exercised, being a writer, will you buy or will you sell? Being a call option writer, if exercised, will you buy the underlying asset or will you sell the underlying assets? Call option holder will buy, the writer will sell. So you are going to sell the underlying asset means you receive strike price of 80 rupees. Or if market price is less, exercised if market price is lesser than strike price, then also you'll receive same strike price 80. Because you're a holder, you sell the share, you get the money. Both the position you sell only. Now shares, you earlier bought, you are going to sell the share, sell the shares. Sell the shares under the options above. Under the options above. Either you sell in call option if market price is high, or you sell in put option if market price is less. One of the places you sell. And you borrow means you have to repay borrowings. So along with interest, 76 into 1 plus point, that is 1.025, you can multiply. 1 plus 0.09 into 3 by 12. That is 1.025. How much? 76 into 1.0225. $77.7. Okay. So what is the surplus? Overall surplus. ET minus 77.71, you get a profit of not 1.71. 80 rupees you receive, 77.71 you pay. 2.29. Let's see if the amount matches. What is the difference between these two? The price mismatch we calculated, it was 2.24. 2.24 multiplied by the time value of money adjustment, that is 1.0225. 2.24 into 1.0225. You get exactly 2.29. The material, the answer hint may be different. Please correct it. There is a small mistake, and not in my solution. That's the institute solution. Keep it as it is. But there is a small mistake in the hint. But this is the correct answer. Okay. Hope it is done. This settlement by net base is not required. We understood the concept. That is sufficient. Okay. Let's go further.